What's up everyone, this is Training Grounds episode 9. Today we will be talking about the much anticipated fair value gaps. So in this video I will only be showing you guys examples of it and then also how it works and how it looks like. And then in the next video we will go over some trades where I executed trades based off of the previous three things that we learned. Liquidity sweep, breakout structure, and then now fair value gaps. So what's a fair value gap? So a fair value gap is basically the imbalance between sellers and buyers. So when there's a strong push, maybe upwards, and then there are no sellers entering positions, that's where you will get an imbalance. So there were a lot more buyers than sellers, thus creating an imbalance between the two sides. So a fair value gap is made up of three candles usually. So it's going to be a smaller candle that begins the push up, and then there's a bigger candle like a bullish candle like this, and then there's a smaller candle at the top which doesn't retrace back into the range of the second gap, so the wick of it does not interfere with the second candle. So let me draw up something real quick here. Boom, this starts it. So this is your first candle in a bullish fair value gap. Whatever, I cannot draw wicks. Okay, then the next candle, we will make it bigger. Maybe you can do it like this. Why can I not draw? Okay. And then this is going to be our next candle up here. And maybe we will draw a little wick here as well. So this is going to be your fair value gap. And then what's actually the fair value gap? So this is what it looks like. What you will see on the charts most likely. The wicks can be bigger, smaller, whatever. But it's your three candles, so 1, 2, 3. And then you get the top wick of your first candle, and then you draw a box or whatever you want. And then you draw it until the third candle's down wick. So something like this. Boom, and this range right here is going to be your fair value gap. Let me make it a different color. Boom, this is your FVG. I'll type it in here. Boom, FVG. Look, right here. So this is your bullish FVG. I'll do that as well. So bullish FVG. Boom. And then we can delete this. And then let's look at an example of a bearish fair value gap. So I'll make that boom red. So it's the same three candle pattern really. You will find fair value gaps that will look a bit different, but if you see this, so the first candle has a little wick, the next one is a bigger push than the first one, and then there's a third candle which the wick of the third candle does not go back into the range of your initial candle, like your second candle. It's a fair value gap. So I'll do the wicks as well. Boom, 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 boom. Okay, good. And then let's see it. So bottom of your, this would be your first candle right here. This one right here, this would be your first candle, because you will see this in the market, because markets went up probably and it's going down, and then that's going to be your first candle that you see. So from the wick of the first candle until the top wick of your third one. So I'll put this in here as well. Boom, bearish FVG. Boom, like this. So the bullish fair value gap, bearish fair value gap. So what does price actually do when we retrace back into fair value gap? So I'll try to make an example here real quick. I'll delete everything in here that we had. Okay, so let's draw a bit of like a chart up somewhere. So let's say market starts at, let's say this will be your market open, and then you will have highs somewhere around here for London session. So these will be your London session highs. You mark that out, and then you see market have like a sharp retrace up here, sweep liquidity, and then we come crashing down. This would be like your ideal trade actually, if you see something like this. So let's look at how a fair value gaps comes into play right here. So maybe we have a bullish fair value gap right here. Boom, boom, boom up here, and then this can be some small little candles, whatever, like this. So you will see like there's a wick right here. Oops, sorry. Okay, so you see a wick here on this candle, maybe, boom, this one here, bigger wick here, bigger wick here, small wick here, big wick here, bigger wick here, big wick, smaller wick, whatever. So we swept liquidity. Okay, so now we have this gap right here. If you see a London high get swept, you usually want to enter short position. So you do not enter off of just the liquidity sweep and just the breakout structure. You can, and that's a good entry. But if you want some kind of retracement or some more confirmation, because we use fair value gaps for confirmation, that basically confirmation is that it confirms us that price will want to go the way that we want it to go. That's actually the easiest explanation I have. So let's say we have the fair value gap right here. So how do you actually trade off of this? Well, you see market coming into the gap and then it totally disrespects it. The next candle you will see after this fair value gap, it will be like a bearish candle. Like, let's do it like this. I'll make it red for you. Boom. And then we come down more. And then this is going to be the final candle. Boom. So what happened here? Well, this fair value gap did not get validated. What does that mean? So when we see a fair value gap right here, we usually want price to kind of come back up. So we want price to go up right here, come back down with these bearish candles, and then somewhere around here we want to see a retracement to see it even go higher. Boom, something like this. Well, this is not what happened, because our fair value gap did not get respected. It got invalidated. What does that mean? An invalidated fair value gap means the opposite is going to happen. So we have a bullish fair value gap right here on the charts. And if you want this to go higher, but it does not go higher, it's because it got invalidated. So that means that this candle right here, it closed below the fair value gap. So the body of this candle closed below the fair value gaps. So what usually happens now? Well, we can just go down and maybe go down to London lows somewhere around here. Boom. And then you would set your take profit here. Your stop would be above your fair value gap. Let me do like real quick. So you entered here. Boom. And then your stop would be somewhere here. Cheeky 2.2, 2.1 risk to reward ratio. You'd have hit this. Boom. Easy trade. And then what else we can have here, I'll make the chart a bit cleaner so we can see it. I'll delete this. Okay. So, we came up here, boom. And then now we're just going to come down. No, not even this, not even this, not even this. So you saw this, right? You saw it get invalidated, but you're like, I don't want to enter here. Maybe it came down all the way here. And the next candle would be somewhere here. And you're like, oh, I don't want to enter here. And then it starts moving back to your initial confluence. So let's say market flip this. We're going up now. Boom, up. We go up, 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 up. And then we hit this level right here. And this would be your bearish fair value gap that you see here. Boom, I'll make this a different color real quick. So it hits your bearish fair value gap now. You see another candle here. which got, I don't know, it closes like this. And then the next candle just closes below this candle. So now you can enter from here instead of from here. So let's say you entered right here, boom, stops, take profit. You'd get yourself a 2.6 risk to reward trade instead of the initial, where was it, like here? Maybe down more, instead of your 1.3R trade. So this is why invalidated fair value gaps are important and how you can catch retracements. So I just want to show you guys a quick example in the markets maybe. Where is it? Let me see something good. Would this work? Probably not. No. Okay, let's see this. So you have your first candle, second, third candle. You have this big imbalance right here in the price. Boom. You can actually go back to the 1 minute. That will help you a lot if you're currently on, I'm currently on the 5 minute. So I would want to look for entries on the 1 minute because that gives us better confirmation and a more solid entry. So you saw this fair value gap. This is even a fair value gap on the 1 minute. Interesting. So, we came up here, swept liquidity. We had our most recent highs right here. Most recent lows were here. Boom. Market broke structure right here with this candle. You had your fair value gap, you were waiting. Boom. Okay, you had this candle. It closed below the fair value gap. So what happened? We came crashing down even more. Let's see, you take your trade right here somewhere. Okay, let's say optimistically, you do it right here. You target maybe these lows. What are these? Oh, this is the New York. Okay, you target some lows. Market probably wouldn't go down here because I think, oh yeah, I remember this push. That was like 3 days ago. But you had your fair value gap here, and then you saw some draws on liquidity. You could have had your take profit 1 here, take profit 2 here, take profit 1 got hit, take profit 2 got hit, full TP hit, easy trade, 2.4R trade, easy as that. So this is going to be part 1 of fair value gaps, and I'll see you guys again in 2 days after a psychology video for more examples and then some more information on fair value gaps. Peace out.